Managerial finance. What is finance? Finance can be defined as the science and art of managing money. Finance at a personal level, individuals make decisions about how much earnings to spend, how much to save, how much to invest their savings and other types of investments. Finance influences everything that firms do, which includes decisions about hiring people or personnel, investing money to earn a profit, how to reinvest the profits or distribute them back to the investors. There are two types of careers: financial services and managerial finance. Financial services deal with the management of money for individuals, businesses, and governments, and includes the design, advice, and financial products. Career opportunities include banking, personal financing planning, investments, real estate, and insurance. Managerial finance is concerned with the duties of the financial manager. Financial managers develop a financial plan or budget, extend credit to customers, evaluate proposed large expenditures, raise money to fund the firm's operations. Professional certifications in finance include Chartered Finance Analyst, CFA, Certified Treasury Professional, CTP, and Certified Financial Planner, which is CFP. The American Academy of Financial Management, AAFM, administers a host of certification programs for financial professionals. Professional certifications in accounting include CPAs, CMAs, and CIA. There are several legal forms of businesses. Sole proprietorship is the most basic and common type of a business structure. It is owned by one person and operated for his or her own profit. It has the fewest rules governing their operations and offers little to no liability protection or tax incentives. The advantages are that it receives all the profits, low organizational cost, income tax on professional tax return. That's income tax on personal tax return, and independence, secrecy, and easy to dissolve. Disadvantages are the owner has unlimited liability, it's limited fundraising ability, it's difficult to provide long-term employment. Owner usually has to perform most or all the job functions in the business, and it lacks continuity after death of a partnership is a business owned by two or more people and operated for profit. A partnership is also a fairly simple business structure. Partnerships also have a few tax incentives and do not protect partners from the business's liabilities. Advantages are it's able to raise more funding than sole proprietorships. Borrowing power enhanced because more owners there's more owners, income tax on personal tax return, and more brain power and managerial skill. Disadvantages are that owners have unlimited liability and may have to cover other partners' debts. Partnership dissolves when a partner dies, and it's difficult to liquidate or transfer partnerships. The corporation is an entity created by law and must be registered with the state and must pay taxes. Corporations are legally recognized structures, meaning they exist as individual entities apart from the people who own them or work for them. However, the owners of a corporation, known as shareholders, are generally not personally liable for the company's losses or liabilities. Advantages are owners have limited liability. They cannot lose more than what they invested. Can large size by sell stock, able to transfer ownership, long life, employ professional managers, able to obtain better financing. Disadvantages are tax at corporate rate, which are usually higher, more expensive to organize, and greater government regulation and lacks secrecy. Other types of businesses, we have limited partnerships, or LP, offers additional protection to the partners. Limited liability partnerships, LLC, offers additional protection to the partners. And the S corporations are a special form of corporation that allows for flow-through taxation like an LLC, but still allows for corporate structure. Managers' primary goal should be to maximize shareholders' wealth. The simplest and best measure is the share price. Managers should take actions that increase share price. Maximizing share price is not equivalent to maximizing profits. So maximizing share price is not equivalent to maximizing profits. Common measurement is earnings per share, or EPS. EPS is calculated by dividing the period's total earnings available for the common shareholders by the number of shares of common shares. So there are 3 reasons why profit maximization does not always lead to the highest possible share price. Timing. Receiving funds sooner than later is preferred. The sooner funds are received, the sooner they can be reinvested to provide greater future earnings. Cash flows does not always mean stockholders' dividends. So a profit does not mean necessarily cash inflows exceeded cash outflows. Certain accounting assumptions can allow a company to show a positive profit. Higher earnings does not mean higher stock prices. Only when earnings increases are accompanied by increased future cash flows is a higher stock price expected. Profit maximization does not account for risk. The chance that the outcome may differ from those expected. Return and risk are the key determinants of share price. Cash flow and risk affect share differently. Holding risk fixed, higher cash flows is associated with higher share prices. In contrast, holding cash flow fixed, higher risk tends to result in lower share price. Stakeholders. The maximization of shareholder wealth is the goal. Many firms will broaden their focus to include the interests of stakeholders as well as stockholders. A stakeholder is anyone that has a direct economic link to the firm, such as employees, customers, suppliers, and creditors. The role of business ethics. Business ethics are the standards of conduct or moral judgment that apply to persons engaged in commerce. Violations include creative accounting, earnings management, misleading financial forecasts, insider trading, fraud, excessive executive compensation, bribery, and kickback. Relationship to economics. The field of finance is closely related to economics. Financial managers must understand the economic framework, be alert to the consequences of varying levels of economic activity, be aware of changes in economic policy. Some examples include supply and demand analysis, profit maximizing strategies, and price theory. Marginal cost benefit analysis is the principle that financial decisions should be made and actions taken only when the added benefits exceed the cost. Relationship to accounting. Accounting and finance are closely related. The 2 main differences are cash flows and decision making. Accountants develop and report data measuring the performance of the firm, assess its financial position, comply with and file reports, and file and pay taxes. Finance managers' primary focus is on cash flows, the intake and outgo of cash flows. Finance managers manages the firm's solvency by planning the cash flows necessary to satisfy its obligation and to acquire assets needed to achieve the firm's goals. Decision making. Accountants devote their attention to the collection and presentation of financial data. Financial managers evaluate the accounting statements, develop additional data, and make decisions on the basis of their assessment of the associated returns and risk. Function includes making investments and financial decisions, determine the type of assets the firm holds, and determine the way the firm raises money to pay for the assets. Corporate governance. It refers to the rules, processes, and laws by which companies are operated, controlled, and regulated. A firm's corporate governance is influenced by internal factors such as shareholders, board of directors, and officers. External factors include clients, creditors, competitors, and government regulation. So the individual investor versus the institutional investor. Individual investors own relatively small quantities of shares so as to meet personal investment goals. The institutional investor are investment professionals such as banks, insurance companies, mutual funds, and pension funds that are paid to manage and hold large quantities of securities on behalf of others. The Sarbanes-Oxley Act, or SOX, was an act aimed at eliminating corporate disclosure and conflict of interest problems. It contains provisions about corporate financial disclosures and the relationships among corporations, analysts, auditors, attorneys, directors, officers, and shareholders. There is a movie out there that I recommend that documents the Enron scandal and the fall of Arthur Andersen, which contributed to the Sarbanes-Oxley Act. The movie is awesome. Not in a good way though, but it really opens your eyes up to the fraud and the deceit that was happening. Anyway, it's called The Smartest Men in the Room. You can rent it, I think, from Amazon for like $2. It is worth the 2 hours to watch it. Okay, so agency issue. Financial managers who own less than 100% of the company is an agent acting on the behalf of other owners. It's called a principal-agent relationship. An agent acts on the behalf of a principal. For example, the shareholder or the principals elect management or the agents to act on their behalf. Agency problems arise when managers place personal goals ahead of the goals of shareholders. So shareholders incur agency costs when managers make poor decisions or have to be monitored to ensure the best investment decision is made. Agency takeover. When a firm's internal corporate governance structure is unable to keep agency problems in check, it is likely the rival managers will try to gain control of the firm. The constant threat of a takeover tends to motivate management to act in the best interest of the firm's owners. So I have 3 questions that I want you to answer. Assessment questions. Describe the legal forms of business organization. Describe the primary functions of financial manager. And describe the goal of the firm and explain why maximizing the value of the firm is an appropriate goal for a business. Now, these answers are in the back of the book. I do not want you to give me those basic answers. I want you to do a little research on the web. I'm just looking for a couple sentence, paragraph at the most. But I want you to reach out and do a little research online and see if you can find a little bit more in-depth explanations than what the back of the book provides. Thank you.